9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne Man with David Ingles.
We are counting down to the open of markets in Greater China. Let's get to your top stories today. Stocks across the Asia Pacific down and down by a lot. Oil jumping as the Iran war enters a fifth week with rising risks of escalation. Global equities are set for their worst month in 4 years, with a key benchmark nearing a correction.
President Trump claims negotiations with Tehran are ongoing, even as Iran's proxies attack U.S. allies and thousands more American troops head to the region.
Also ahead, BYD warns of fresh pain ahead for China's EV industry after delivering its third straight quarter of disappointing earnings.
And with earnings season underway, we speak to two key players in the Chinese biotech sector. Stay tuned for our interviews with executives from Innovent Biologics and Hua Medicine. Well, Dave, we came out this weekend with just more news of signs of de-escalation, along with some of the diplomacy that's underway. But it seems like markets right now are really focused more on this conflict really widening now that the Houthis have really entered into this Iran conflict.
Yeah, because literally that is a threat to the other choke point, which has managed to offset some of the issues right now and on logistics. And I think the oil price right now reflecting that 115, 116, and then you also have on top of that other components of the aluminum of the commodity complex. Aluminum is also a very good example. So markets are selling off, and I think for once we talked about BYD, right? For once, the earnings story won't be an offset to the challenges on risk assets from the macro side of things, because the earnings story is also quite disappointing when you look at Chinese markets
today.
I
think once we get closer to getting March and April data, right? Yeah. February data so far has been quite stale, given the fact that it hasn't reflected what this Iran conflict might have on economies here. Once we start to get some of that data points come through, to see what this energy shock has had on basically the data, earnings as well from CEOs, that might start to see where we start to really focus not just on the inflation shocks, but really now maybe the growth risks moving forward too from this whole conflict.
The PMI numbers, right? So we are approaching calendar month end and the first few days of the calendar month of April, and I think that's really when you're going to get a lot of these PMIs coming through, which would be the first indication, right? See, and I suspect my suspicion is some of the estimates out there haven't quite reflected yet some of the pain that will likely show up in these numbers, and hopefully I'm wrong when it comes to that, of course. But when you look at markets, for example, it doesn't really take a lot to stretch, that tangent between where you are as far as the war goes, and really the pain these economies are feeling at this point in time. In fact, just on that very note, right? You have oil prices right now 117 right now, and Brent we're back above 100 on West Texas. We talked about the equity markets on track for the worst month going back to about mid of 2022. In fact, just a little bit more. We have two days left that we could actually take out that threshold and would be, in that case, and hopefully I'm wrong here, the worst month for global equities since the pandemic hit back in 2020. Just underscores how unprepared markets were for this. And I think further on as well, flip the page, please. When you look at currency markets, intervention risk now with 160 on dollar yen. That's a little bit stronger right now as far as the Japanese currency is concerned, following comments earlier on, which we'll get to in a moment. Equity markets, you have the Nikkei off 5%, Kospi's up 3, down 3 or 4. Taiwan is coming online, and when Hong Kong comes online, do expect it to reflect not just this, but also the BYD effect, because that stock is likely going to take a massive hit today. Coming up on your screens, A50 futures, and of course you have aluminum and also Shanghai. We're also focusing on these two specifically in the Chinese mainland exchanges.
Yeah, some of these Middle East plants were hit by the aluminum ones, so certainly that's one thing to watch here. That's why you are seeing that spike up in aluminum prices here this morning. But let's get to the latest here when it comes to the Iran war. And bring in our politics editor, Laura Davison. Also, here's our Asia oil trading reporter, Rong Wei Neo, joining us from Singapore. Laura, I'll start with you. The Houthis entering into this war, how much complexity does this add now to the whole conflict?
It certainly sort of opens that door to having other actors enter the fray. It's just another, a card that Iran can play to have more leverage, to have additional locations to fire missiles, but also for all of those Gulf allies that we're, thinking about last week. Do they get in? Do they not? What is their role in in here directly, that just adds that much more pressure as there's that, much more risk for them going forward. So that adds a lot of complexity here. Plus, we also, we heard the Trump was rather quiet over the weekend, but we've heard a lot from him just today. He's, just spoke with reporters on the plane, said that there was, that Iran has given in to many of the demands that the U.S. has put out in their 15-point plan. Really unclear what he means there. He didn't specify what that was all about. But just, a couple hours before, he gave an interview to the Financial Times where he said that he wanted to take Iranian oil. So again, we continue to hear mixed messages from the president about whether a peace deal is imminent or, could there potentially be some large-scale ground operation, in which he said that U.S. troops would be on Karg Island for a long time.
Where are we on, just to build on that, the diplomacy front, right? Whether that's between the U.S. and Iran and whether the Iranians have responded to some of the claims from the U.S. president, and also separately, these talks that Pakistan wants to broker between all parties involved here.
Yeah, so there were talks over the weekend, not between the U.S. and Iran, but with intermediaries in Pakistan. So you had Pakistani officials as well as Egypt and Turkey who were also there. They have kind of played that main role there, trying to sort of bridge the gap. It still is not clear that there are any direct talks happening between Iran and the U.S. Although Trump just, as a couple minutes ago said that there were both direct and indirect talks, Iranians have continued to deny that. And as we've seen, sort of, all these different signs, Trump continues to push a peace deal, at least publicly, but privately, there are lots of conversations about a ramp up of U.S. military efforts.
And, just on the commodity front, aluminum has now been pulled into this. Some of the assets in the Middle East have been hit. What do we know about that?
This is sort of yet another, kind of commodity that's going to be, up, I think, almost 5%, is what we saw most recently. This is just adds to sort of what has been a really, really bad case scenario for the economic outlook. I'll note, the White House kind of we're now in the 5th week of this war. They said in 4 to 6 weeks is when Americans will start feeling the economic impact of that war. We're now in that time period. We're seeing, as attacks ramp up, that, things are headed in the wrong direction from an economic stability perspective.
Yeah, it's a good point, Laura, because, when it comes to oil, that certainly is the big key focus here right now, is now that the Houthis are joining on the fray, how does the oil sort of story evolve, right? And is the sort of oil shock that we've been seeing from the Strait of Hormuz about to head west? That's a key question here, because what we have seen here, of course, is the Strait of Hormuz, the effective closure of that. What the Saudis and some of these Gulf nations have done is really redirecting a lot of those flows through this east-west pipeline right here. And what they do is kind of go through what we call this kind of gate of tears, or the El Mantab Strait, I should say. So if the Houthis actually talk about or even look at targeting this key area, this is where you start to see, right, those exports from Saudis via that Yanbu port into the Red Sea. I mean, that has reached, up to 7 million barrels a day. Could this now be the next oil choke point if, in fact, these sort of Yemen-based Houthis are now joining in on this fight here? Just to stress, though, there has been no reports of them attacking this area just of yet, Dave. But certainly there is some concern that, even the alternative routes could lead to more alternative routes, right? Will oil vessels, will tankers have to be redirected away from this area, now away to the Cape of Good Hope through Africa before getting through to their destinations?
Yeah, and I think that some of the early estimates out there, and I think that's good that we point that out, because there have been still no threats on large vessels, but of course markets are an anticipatory group, and we're looking at worst case scenarios, and I think our folks in BI have mapped this out. $15 to $20, I believe, is what they're panning out there in as far as possibly the additional premium to oil prices are concerned. Let's bring in Wrong Way, who's with us right now, to talk us through what's at stake here. And, we talked about the potential second choke point that could be in play here. How are energy markets supposed to be looking at this this increased risk right now, Wrong Way?
Right, David. So we've seen the market sort of take this news into consideration as we have seen oil prices open higher today. It's a mark of escalation with the Houthis so-called throwing their head into the ring. And of course, a lot of concerns over this because when the Strait of Hormuz was blocked off due to the ongoing Middle East conflict, Saudi Arabia was one, or if not the only Middle East oil producer that has a bit of a safety valve. And in this case, it was the east-west pipeline that Yvonne, you have talked about. So a lot of this crude oil has been diverted via this pipeline and loaded at the port of Yanbu. So which is why even though we have seen major disruptions across crude loadings from the Middle East, that was still one of the only safety lifelines. And David, like you mentioned earlier, this pipeline is in full capacity, but do note that it's 7 million barrels a day of capacity. It's probably about half of what Saudi Arabia was exporting before. And now with the Houthis in this situation, there's of course increased risk that any sort of attacks on ships, and similar to what we have seen back in 2023 when the Gaza war broke out and Houthis began attacking Israeli-linked ships. That has caused a lot of panic and concern and has forced a lot of ships to divert away from the Suez and the Red Sea and choosing to take the longer route around the Cape of Good Hope instead. And of course, the Yanbu port lies within that region. So if such attacks happen, we are effectively closing off our last, I would say, our last only open outlet for Middle Eastern oil to flow out.
Yeah, you say a really good point here, right? This is probably the plan B is now becoming a threat. So what does that mean for oil prices moving forward? We already saw that spike up this morning. What are we talking about, a new trading range now for oil prices moving forward?
So even before this news broke out, a lot of banks and analysts were considering scenarios where oil prices could go up to as high as $200 a barrel. And I believe with this weekend's escalations, that scenario is looking a lot more firmer than before. Now, of course, when we talk about this disruption here, potential disruption here at the Red Sea, we do have to bear in mind that the Houthis have not directly declared that they will be doing so, attacking ships at the Red Sea. A lot of things are still anticipatory by the market. It's just that that element there is a real risk factor that the market has to consider. And if we look at the ships around in the Red Sea, a lot of ballast tankers are waiting off Yanbu, waiting to load up crude oil. So if any sort of escalations happen there, all these tankers would essentially be stuck as well. It is similar to the situation we are seeing at the Strait of Hormuz. So putting all these in mind, markets are expecting higher prices, but it also depends on how things pan out. Like Lauren has mentioned earlier, when Trump was speaking with reporters on board the Air Force One, there were some hints that potentially we could see some sort of more conclusive, concrete peace deal being done. And of course, traders are keeping their eyes wide open for this. But as of now, we don't have any clear indication of that happening anytime soon.
One of our regular guest, Mukesh Sadev, out of Ex-Analyst, had a quote on this. This would be akin to denying a patient bypass surgery when they're having a heart attack. That would address the heart attack. Laura, just some final thoughts. What do we need to be watching on for next today?
Two key metrics to watch. One, about 3,500 U.S. troops arrived in the region over the weekend. There's still a couple thousand more en route. Once those all get there, what are the positioning of ships? What does that look like? Is there a ground invasion imminent? There were several reports over the weekend. That's coming. Second, does the U.S. send any top diplomats? Does Marco Rubio, does J.D. Vance, does anyone go to the region to have conversations with these intermediaries? That would suggest that peace talks are on have more momentum versus the troops, which would suggest that a military option is more in the offing.
Laura, thank you, Laura Davison there, our politics editor. Also, Rongwei Neo, our Asia oil trading reporter, joining us out of Singapore. Coming up, our exclusive conversation with Innovent Biologics after the company posted its first annual profit, plus their outlook when it comes to obesity drugs as well. We're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. We are going to be bracing for what could be a pretty brutal sell-off here today across the region. Futures are down more than 1%. This is the China Show. Your agenda for Greater China today, we're watching some key technicals when it comes to Shanghai. The CSI 300 is on the cusp of really kind of around or breaking below that 200-day moving average. And certainly BYD is the one to watch. Is this the one that's going to really take markets lower here, given that we saw the profit plunges that we saw 38% in the fourth quarter. ADRs were down some 9%. So we'll see how that performs in Hong Kong today and whether it does drag some of the other EV makers with it. Chinese banks also came out with earnings over the weekend on Friday as well. Xiaomi is also in focus here, but the sector to watch, of course, is energy. Aluminum, just given that we had seen some Middle East plants that were targeted over the weekend as well. Also, we have the Citi Hong Kong macro conference to tell you about, so some guests coming through here throughout the morning.
Yeah, Jim McCormick, who's head of macro, will be joining us in the next hour to talk us through this. In fact, when you look at the earnings story, and I think one of the things we'll be asking him is whether we need to be looking out for a round of earnings downgrades at some point in the next few months and quarters because of what's taking place. In other case, we're looking at a lot of Chinese companies are set to report today. Stay tuned for that. It's everything from Country Garden all the way through to some of the big banks like Agbank and China Eastern Airlines, really on the back of that. The macro picture on travel, fuel prices really comes together, the intersection when it comes to the airline space. Futures are now 1.5%, so we are set to join this risk route, I think substantially. I think we're about half of 1% now away from entering a technical correction on the MSCI all-country index. The global benchmark is now down 9.4% from that recent peak. Paul Dobson, our executive editor for Asia Markets, is with us right now out of Singapore. Among the many fronts we talked about here, why don't we start with stocks here, Paul? Quite some pain being priced in today.
Yeah, it's kind of that weekend risk thing again, David, where everybody on Friday is scared. Maybe there'll be some good news at the weekend. Maybe they'll see some bad news at the weekend. What do? You wait over the weekend and see, and then the market reacts very sharply one way or the other on a Monday morning. So we're down quite a long way, particularly Nikkei and Kospi already. Remember last Monday, it was quite a similar situation for us. It was negative all the way through our day. We went home 7 p.m. Out came the news. More optimistic on the idea that there might be some peace talks and the market rallied. This time we already heard from Trump the talks are progressing well, but the market really hasn't taken that much comfort for it. So I think that it shows you the longer this goes on, the more immune to the chances of a good news or turnaround the market is, or the more convincing it will need that this is real in order to react with such a sharp move up, and the more that the economic pain is getting priced into the equities and the global market complex as a result.
Yeah, Paul, you mentioned, stocks are certainly taking a hitting here today, but when I take a look at inflation expectations, those seem to be rising. But then again, treasuries have been rallying. Gold is actually being supported now, despite what we're seeing with the dollar moves. Do you think the positioning in some way is now changing, where it's not just about the inflation shock, but really have to start thinking about the economic scarring and growth risks moving forward?
Yeah, Yvonne, certainly more and more people seem to be talking about that. The idea that government bond yields have risen too far, too fast relative to what central banks are actually likely to do. I think that makes a lot of sense because central banks, for one thing, are very slow moving, and two, they have to have a mind on the economy and growth as well as the inflation outlook. Even with a pure inflation mandate, if they were to hike aggressively into a big economic slowdown, then that could perpetuate things even more. So what we're seeing is the likes of PIMCO, JP Morgan saying, just a second, maybe the market has gone too far here. Maybe you want to lean against some of that pricing in short-term interest rates and perhaps even have a look at the back end of the yield curve as well, where there's more value having seen such a hefty sell-off. So I think that maybe bond markets are starting to find a little bit of that equilibrium or even tipping over again. It's key to listen to the central bank speakers. A lot of them are sitting on the fence so far, worried about inflation, yes, of course, but the longer this drags on and the more we actually see that impact hitting the real physical world, our day-to-day lives, the more people are going to be talking about a slowdown in the economy rather than just the shock of inflation.
Paul, I just want to note this for our viewers right now. BYD in early goings here, down about 5%. That's one stock along this entire cohort of APAC stocks we'll be tracking, of course, auto stocks specifically, given the earnings. That is, of course, a bellwether. Paul, just a quick note on aluminum seems to be pulled in quite substantially now, given I think some of the destruction in some of the assets in the Middle East. What do we know about that?
Yeah, so I think what we saw over the weekend is the metals are now fair game as part of the sort of targets for both sides, and so the fact that there were strikes on aluminum smelters in the Middle East has knocked out some of the production, ratcheted up prices. It will create winners and losers for those people that are producing aluminum in other parts of the world and have access to energy supplies for it. Then they're going to be more in demand. But I think that have a look at those metals prices and that complex and see how this impact is going to spread as the war sort of broadens again into new areas. And that's the danger. And again, that compounds the inflation risks and the slowdown risks all in one go.
Paul, thank you. Paul Dobson there, our Bloomberg executive editor for Asia markets, joining us as we've been talking. Chalco shares already up some 5% and really following the price of aluminum here this morning, those LME contracts. BYD, as we talk about, is certainly going to be the key focus here, just given what the remarks that we heard from the chairman as well, Wang Chuanfu. He says, it does seem like there's more pain ahead, right? He says they've reached a fever pitch competition-wise and undergoing a brutal knockout stage. Perhaps that's why you're seeing the stock being knocked out quite a bit here this morning. Let's take a look when it comes to the free market and how this is going to play out for Hong Kong here today. We're at 101 when it comes to BYD. Hang Seng, there you go. We're down more than 400 points at the get-go there. 692 for the currency. This is Bloomberg.
Right, well, welcome back. So the Iran war has engulfed markets pretty much the entire month. It was that weekend, of course, going into March, and of course we have 2 more days left in the month. And just to underscore the relative resiliency of Chinese markets, which really was perhaps more obvious at the front end of March than it is last week, and I'll show you the chart in a moment. But yes, we are set for the biggest monthly outperformance since August on the CSI 300, right? But all of that being said, the CSI 300 at 4,500 is now actually testing this 200-day moving average. It hasn't actually done that since Liberation Day, 11 months ago. And we had this massive gap lower last week. That next chart's about to show you that. Just something to watch, I guess, as we move into the thick of the session today, where you have this earnings story and the BYD issue that might also compound some of the downward pressure on the major benchmarks. The offset, of course, are your big aluminum plays, of course, and also energy, given, of course, that is a very heavily weighted sector. But anyway, want to watch here, and we are currently just above that by several points, that key level specifically. Yvonne.
Yeah, interesting to know, right? They maybe be immune, but maybe not so much more if this continues to drag on. When you talk about economists already pricing out the possibility of rate cuts from China, just given what we've been seeing with the disruptions when it comes to energy, and even when it comes to, of course, inflation coming back in China, given the price that we've seen when it comes to oil. Hang Seng, of course, is looking pretty brutal here this morning. Look at HS Tech, we're down close to 3%. Of course, we'll track all things EVs. BYD, there you go, down. Continuing down by 4.6%. We got the open coming up next. This is Bloomberg.
Right, we're looking at a sell-off across risk assets going into the Monday open. We're also coming off, as you're here in Hong Kong, coming off Art Week, and just part of that, of course, surreal, abstract, really in some ways, as markets try and paint a picture of the future, which is increasingly bleak by the day. 5th week now of the Iran war, and equities are taking it on the chin massively going into this Monday open, Yvonne. Yeah,
you got the escalation with, of course, the Yemen-based Houthis that are joining in on this Iran conflict now and attacking Israel over the weekend. And you square that with diplomacy and the meetings that have been happening underway. It seems like markets are really focused more on the former than the latter here right now on what this escalation means, right? When you have more regional players adding into the fray, does this become a more widening conflict that, even the U.S. cannot control? That certainly is one sort of narrative that's playing out. And equities are now starting to really take it on the chin here. If you take a look at how onshore equities are doing, you have Brent at around 116. So the energy spikes, that certainly is one thing to watch. Aluminum also spiked some 5% this morning, too, when things opened up. So that's why you are seeing stocks now down about 0.9%, the CSI 300. As Dave mentioned, that 200-day moving average, we are at risk of breaking below that here right now. So even with China being, relatively speaking, insulated, they have cheap imports. That's always been sort of the safe haven. Maybe China might actually be dragged down from this as well as this conflict enters into a fifth week. We're seeing copper prices also being knocked out here this morning, but Shanghai crude following the price of Brent and WTI here this morning, we're up some more than 5%. Large caps are mostly lower here this morning. It's pretty indiscriminate here right now. You are seeing the likes of Capricorn Tech, Medea Group down some 2%. CATL slightly lower here this morning as well. But let's look at the boards and see how Hong Kong is doing, because you also have the earnings aspect to all of this, particularly when it comes to the BYD story. So there you go. HS Tech is down some 2% here this morning. We're back below that 25,000 level for the Hang Seng. And we're talking about a renminbi that's actually weaker, right? Given the dollar is much right now still that safe haven amidst all this volatility. But it's interesting to see how positioning has changed. Brent is up. Swaps of U.S. 1-year, 2-year swaps are also up. But treasuries are catching a bid here this morning. Gold is also catching a bid here this morning. So is the reaction function among investors changing in some ways? Because now it's not just about inflation shocks, but I have to look at longer term, the long tail risk of maybe economic scarring and what this means for the growth pictures. And can central banks in Asia actually afford to raise interest rates? Does that actually bring oil flows back? No, right? So the demand destruction story could be one reason why we are seeing these concerns among risk assets here today. But take a look at the tech space. It is seeing a pretty brutal sell-off here. Baidu's down some 4.5% here. Alibaba's down some 3%. Tencent is down some 2% this morning. But it really has been on the BYD. But before we get to that, let's get to the aluminum stocks, because not just the oil story, but aluminum also spiked, right? So that's why you are seeing the likes of Chalco up some 5% here. Tianshan Aluminum also down up some 10% after there have been some reports of some of these Middle East plants that also were attacked over the weekend. So it's not just an energy story, but we've got to take a look at the metals too. That's also an added complexity to this whole Iran situation. And then we got to focus on fundamentals with BYD, right? Pretty brutal when it comes to the fourth quarter. We did see that plunge of profits of 38% here, and continuing disappointment when it comes to the earnings side for BYD. And for the chairman to come out with a statement to shareholders and saying, look, this competition is still at the fever pitch here, and we're still at kind of knockout, sort of brutal knockout. We're seeing when it comes to at least the EV side of things is continued sell-off here. At least BYD, we've come off some of the initial sort of selling here, but we're still down about 1% here. But yes, XPeng, NIO are seeing losses of more than 3%, Dave.
Yeah, has reached fever pitch and is undergoing a brutal knockout stage was the exact comment there from in the letter to shareholders on Friday from the chairman. One can't help but think about this in the context of, I think, some of the other platforms where, before we got into this competitive spiral, I'll use Meituan as an example, right? Folks were talking about how whether you look ahead to what's been happening in the car market and whether or not they were headed in the direction of the platform companies. I think that statement just underscores maybe that they are on the fringe of that potential reality. Okay, well, one other sector on the earnings front that has also seen substantial growth, but also could see some competition. Let's borrow that word fever, right? Let's talk about pharmaceuticals here. So Innovent Biologics reported net income full year late last week that actually missed the average estimate, though analysts are upbeat on the global sales potential. You look at the pipeline coming from the company. It's oral weight loss drug. It's quite a substantial pipeline and product line across many other verticals. Joining us now exclusively from Shanghai is the CFO of the company, Rachel Yeoh, to talk us through the earnings and the outlook ahead. Rachel, good morning from Hong Kong. Thank you for taking the time. First full year profit. Talk to us about the momentum you're seeing and whether or not you see that translating to 2026, Rachel.
Thank you, David and Yvonne. Definitely, we are truly proud of what we have achieved in 2025. It's probably the most successful year in Innovent history. Like you just mentioned, it's the first time in our history to achieve full year profitability under IFRS. So our net profit and IFRS reached RMB 814 million, and the IFRS net profit reached RMB 1.7 billion, a manifold growth compared to 2024. Also, we deliver very strong top-line growth. Our total revenue reached 13 billion, and the product revenue reached RMB 11.9 billion. One thing I would like to highlight here, Innovent only took 7 years from the first product launch to RMB more than 10 billion scale. We are probably one of the very few companies in China who can deliver such strong top-line growth at this scale, which positions us a very unique industry leader in China. We also made quite a lot of milestone development in terms of the global innovation partnership. Looking at our global innovation, actually, we are actively moving 3 late-stage high potential assets into the next stage global development. Our 3 leading assets, including IBS 363, IBS 343, and IBS 324, they are either in global phase 3 study or ready for global phase 3 study. More importantly, the combined market opportunity for the 3 leading assets are more than $60 billion, according to our partners' estimation. So the actual means, any further progress in the clinical development of these assets in any particular indication is going to substantially unlock the upside value of the company. Last year, you may also notice that we entered into a few remarkable partnerships with Lilly, Takeda, and Roche. So definitely, Innovent has built a very diversified partnership network with different collaboration models.
You've partnered with like 30 global healthcare companies, Rachel. Can you talk a bit about that? Because it reached over $22 billion US dollars. In terms of what you're looking at for deal volumes in 2026, are you likely going to surpass that number, you think?
Sure, definitely. Actually, as you just mentioned, the total deal value Innovent achieved last year was more than $20 billion US dollar, account for more than 10% of the total deal value in China. And actually, we're seeing very strong deal flow currently in China. So if you look at the deal value in the first 3 months this year, it's more than $60 billion, account almost half of the total deal value last year. So basically, I think, China is becoming the new source of innovation for the multinational players. We also anticipate the China biotech sector is going to play an increasingly important role in the global ecosystem.
Rachel, let's zero in on obesity, which you guys were the pioneer, of course, domestically. And can you give us your outlook for your specific product in the market this year, and against the backdrop of, as you would know, competition that's coming in, perhaps lower prices? And are you prepared to lower prices if you do want to go that route?
Yeah, thank you. Definitely, obesity is a very hot topic recently. And actually, all the GLP-1 players in China, they officially launched their obesity indication since last year. So, but I think one thing I would like to highlight here, we believe, China market, if you look at the penetration of GLP-1 class in obesity treatment, is extremely underpenetrated compared to US and Europe market. The current penetration in China is still less than 1%, as compared to 10% in the US and 5% in UK. So definitely, there are going to be dozens of players in this sector, but we still believe, given the huge market potential there, we are still very positive about the outlook of the GLP-1 class in China.
Yeah, well, can you tell us a bit more? I mean, the market seems to be changing when it comes to weight loss drugs, right? When you have that patent for Ozempic, now recently expired, does that pave the way for more kind of these low-cost generics to come into the market? Does that force you at Innovent to really kind of lower your prices then for your weight loss drug?
So definitely, I think the market is very dynamic, this year. And also, like you mentioned, for the other GLP-1 brands, they lower their price, get onto the NRDL. But I think if you look at, how GLP-1 is going to being ramped up very quickly in the U.S. market, even though the price went down year over year, but you can see the substantial improvement in terms of the penetration and the DOT. And we believe, if China obesity market could benchmark the current penetration rate in the US, there are definitely more than 10 times of the growth potential. And I think, every GLP-1 player here in China, they are trying to find the right pricing point to drive the improvement in terms of the penetration. So we think, obesity market is definitely different from the oncology market with a huge potential. So we believe, going forward, even though, there will be quite intense competition, but the overall market size is definitely there.
Okay, and could you give us a sense, if you are correct and the market is able to sustain its current momentum, how big of a portion of your revenues do you see obesity relative to your other pipe? Oncology, of course, is a very big growth driver for you. Mark, just want to understand, Rachel, how big of a driver obesity is for you guys.
Yeah, definitely. If you look at our strong growth last year, our oncology portfolio still sustained very good growth momentum. But you can see CVM portfolio has emerged as another key growth driver to our overall business. Definitely, mazdutide, contributed quite a lot since its launch in July last year. But in addition to mazdutide, we also see, high potential products emerging from the CVM pipeline, including our PCSK9 and also our IGF-1R for the treatment of thyroid eye disease. So going forward, we reiterate our target of reaching 20 billion RMB product revenue by 2027. And with just 1 year away from that target, I think we see more visibility and certainty. So obviously, definitely still going to be a quite important contributor to the overall revenue, but we're also very confident with other high potential portfolio assets within the company.
And you do have ambitions also, to become a global competitive biopharma by 2030. What is the scale of your non-Chinese operations now, and how much is the company willing to invest for your overseas expansion?
Yeah, if you look at our existing, product mix, I think the major contributors still come from our domestic business. But as you just mentioned, definitely we're aiming to become a truly global premier biopharmaceutical company with 5 assets moving into global phase 3 by 2030. So, like I just mentioned, if you look at our pipeline this year, we already have 3 leading assets, either in global phase 3 already for global phase 3. We also have a very innovative pipeline. We are moving those molecules into, IND stage or POC study stage. So basically, we are very confident with the 5 assets in global phase 3 target by 2030. And also, if you think about the revenue growth momentum, our current revenue growth is mainly driven by the domestic pipeline. But starting from 2029 or 2030, I think the global revenue is likely to kick in. So we are not only positive about the revenue growth from 2026 to 2027, but we are also very positive about the overall revenue momentum from 2030 to 2035.
Rachel, we got to leave it there, but thank you so much. Rachel Yo there, CFO of Innovent Biologics, joining us out of Shanghai this morning. And there's more on China Pharma earnings coming up. We're going to discuss Hua Medicine's report and their expansion plans with the Chief Strategy Officer, George Lin, after sales of a pioneering diabetes drug nearly doubled last year. This is Bloomberg. Circling back to BYD now, which is hosting its earnings call right now. And really, we've actually seen the stock turn positive, despite what we saw in the ADRs overnight and really what the pre-market was suggesting that could have been a pretty brutal sell-off. Well, things are coming back. But now this statement from the chairman, Wang Chunfu, was quite telling, right? Warning of more pain ahead for China's EV sector, and really kind of with all that boxing sort of analogy, a brutal knockout stage when it comes to the competition. Let's bring in our China automotive reporter, Linda Liu. She joins us from Beijing here this morning. I mean, it's interesting, the stock and what it's doing now, but what are we hearing so far in this earnings call?
We're still waiting for some details from the earnings call, but what investors are really watching for is a guidance for BYD's total sales goal coming into 2026. We're going to see if growth is going to slow from the explosive surges that BYD has seen in the previous probably 2 to 3 years. And the other thing we're really watching for is how confident, the CEO Wang Chuanfu is with BYD's new technology, such as its megawatt flash charging, is going to revive some of the consumer interest in BYD's products.
Linda, what's the sense we're getting? That statement was interesting that we led with there, the knockout stage, right, which typically is the most brutal part, but it also means there is you do see the light at the end of the tunnel. It means you're towards the latter part of whatever competition you're in. Are analysts going to be zeroed in on whether or not there is a timeline for BYD and when they think this competition will likely ease up?
It's actually a hard question to answer. Everyone from the EV makers to regulators are probably all trying to figure out how this consolidation stage is going to shake out. So right now, probably the remaining players in China's EV industry still have a bit of a way to go. You're seeing some of the smaller EV brands like NIO and XPeng, they're still delivering quite healthy sales. So the knockout stage is still ongoing, but we're already seeing signs of existing brands exiting the China market. So Volkswagen's Skoda brand just announced last week that they're going to stop sales in China while still providing servicing to customers. So some of that, players exiting the market can be seen in legacy brands, so mainly in gasoline vehicles, these type of companies exiting the China market.
Linda, thank you for breaking that down for us. The earnings call, of course, I believe is underway. Shares have shaken off the early weakness. We're now slightly to the up, slightly higher, 0.4% here in Hong Kong. Right, that's really one of the few areas of green we're seeing across these markets, because the backdrop is this. We'll see you in a bit. This is Bloomberg.
Some more earnings to tell you about this morning. PetroChina's earnings fell last year as softer crude oil prices and sluggish fuel demand weighed on profits. The country's latest and largest, oil and gas producer reported net income for 2025 of $22.8 billion. That's compared with the $23.8 billion a year earlier. It also forecasts higher capital expenditure this year. China's largest banks have so far reported flat earnings for 2025 as they contend with government mandates to support a cooling economy and a prolonged squeeze on profit margins. ICBC, the world's largest lender by assets, says net income rose 0.7% last year to $53.3 billion. Profit adds China Construction Bank, meanwhile, gained 1%, with Bank of Communication posting a 2% increase. Ag Bank and Bank of China report later on today. And PopMart is looking to expand how it uses its intellectual property beyond toys. The company's CEO told state media that its IP can extend into theme parks, video content, and desserts. The maker of Labubu dolls is facing questions over how long the hit characters can keep driving growth. Xiaomi CEO says the company delivered more than 4,000 units of its new generation SU7 electric sedan in the first week of sales. The model was officially launched on March 19th. Lei Jun had already set a goal of delivering 550,000 cars in 2026, up 34% from last year.
Okay, just on the earnings story, and Meitu, of course, is both an earnings story and it's also a crypto exposed name. And with crypto doing what it's doing, understandable why the stock is under pressure as well. Just adding to the list of stocks that are seeing some downside for really a varied amount of reasons. Specifically for me, too, it's those two. They're missing estimates on the bottom line. Right, a bright spot in these Chinese markets and also across the region, aluminum, some of the producers and exposed to that metal, of course, following now its aluminum has been dragged in to this with hits on some key production assets in the Middle East over the weekend, and you are getting some commentary coming through that it has now, of course, become something to consider. Chalco is up 7%, and that takes you down the list, of course, into similar amounts there. We're up 4% on the London contract. Shanghai contract is also up quite a bit as we speak. The yen story is interesting, something to keep an eye on. 160, of course, on Friday. We pulled back from that level, and we are getting, I think, maybe perhaps the first sign here of that intervention might be something to at least think about. Verbal intervention here coming from the Japanese. It's pulling dollar yen back down.
Yeah, bold action may be needed. So certainly we'll see if anything follows with the verbal sort of side of things. But then again, you take a look at when it comes to oil markets, and yeah, they're certainly watching very closely what energy prices go. When you're talking about Brent back to around 115 levels here right now, WTI is back above 100, and aluminum prices are surging some 4%, and now they're the next direct target when it comes to aluminum in this whole situation. Then yeah, there are concerns that the supply disruptions are widening and getting bigger in some ways. That's why you have BI say, look, if we're starting to see that this oil chokehold can move further west, right? If we're talking beyond the Strait of Hormuz to the Gate of Tears and this east-west pipeline, does that mean we have to put another $15 to $20 price premium on the price of energy? Macquarie was saying $200 oil if this conflict continues and drags on until June.
Yeah, I mean, if oil reaches 200, the oil price is probably one of the last things to worry about. Just think of the underlying conditions that would merit that oil at that level. But yes, I think Macquarie's out with that price target given those conditions by June. Lots more ahead. We have plenty more on the way here in the next hour of The China Show.
Welcome back to the China Show. A look into the HSI half hour into the session, and we are still around the session lows here right now. We're seeing downside about more than 1.5% here. 8 shares are following a similar measure. Still looking relatively better than the rest of the region here this morning. We were talking about losses of much as 4 to 5% in Japan here this morning. Kospi is lower by about 3.5%. So certainly you're seeing equities wake up to the reality that possibly we're seeing an escalation to this Iran conflict, given that the Houthis have joined into the fray as well. At the time that we are still seeing diplomatic efforts that have been underway, markets tend to kind of focus more on the potential oil disruptions and the chokeholds that we're seeing here this morning as well. So certainly we continue to see no let up in sight here when it comes to risk assets in this risk-off session here this morning. Earnings like BYD haven't been too pretty here, so that's also dragging a little bit of the EV space as well. But this is what the rest of Asia is looking like, right? The damage report on this Monday morning as we enter a 5th week into this conflict. And we're talking about, oil prices that continue to see a pop higher. When Brent woke up this morning and we were talking about 115 oil, WTI is back above 100, 101. And the likes of Macquarie is saying, look, if we continue to see this drag on, it's up until June, we could see oil up to $200 here if the Strait of Hormuz remains shut. They're putting 40% odds on that scenario here, which is not minuscule, right? U.S. futures and Europe futures are looking like this could be also a pretty painful morning to wake up to in Europe as well as on Wall Street here today. The dollar still remains quite king here, still the safe haven of choice in the face of this. Although you have been seeing a little bit more of the Japanese talk about it after we did see dollar yen briefly hit that 160 level. We're back just slightly below that here right now after we heard from Mamuro-san saying bold action may be needed if this situation continues. So just verbal intervention for now, but you are seeing some weakness across the board when it comes to ENFX. I think emerging assets have seen a 4th straight week of declines already since this war began. Brent crude, as I mentioned there, 115. WTI is at nearing 102. Aluminum, is this the next industry to watch here as a direct target in this Iran war, given the fact that we have seen some plants that were targeted in the Middle East overnight, or over the weekend, I should say, were up 4%. So the aluminum players here in Asia are catching a bid here, and gold taking a back seat once again. Dave.
Yeah, and I think when you look at Asia EM, you're right. I mean, it's really the EM space which is taking the hit. In fact, when you look at Asia EM, right, we talk about this, the exposure to the Strait of Hormuz. That's mostly really an Asia EM issue when it comes to that pipeline or that route, of course, that takes energy. Right, now, and the Houthis are now involved, right? And I think that's really what is getting priced currently. Now, it's worth pointing out, too, that the Houthis have not actually said that they are planning to target some of these tankers that are going to the Red Sea and out the Gate of Cheers, which I'll get to in a moment. But they are capable of doing that, and markets are anticipating worst-case scenarios. Saudis in white. You have the Red Sea here, Persian Gulf, Oman Gulf, Strait of Hormuz. The Gate of Cheers is here. This is this pipeline, the east to west, which has now reached at about, I think it's about full capacity now of about 7 million, which is obviously a big help. But if that then dries up, as we were pointing out earlier on, Mukesh Shadev, who comes on our show from Ex-Analyst, likens that akin to cutting off, denying the patient bypass when they're having a heart attack, right? So just to give you a sense, that's the map just shown another way. You have all these tankers lining up that have gone through, instead of going here, they've gone through here and been waiting at the port of Yanbu to pick up, to effectively then transport oil down throughout. Now, the issue there is if they get closed off, then they have to go all the way around the Cape of Good Hope, which you really have to take an entire globe and zoom out to take us down through the Horn of Africa into the Asia Pacific. So that obviously adds everything from costs. But yeah, just to give you a sense, that's where the oil pipeline ends. This is where you have all the tankers. And we've actually yet to see actual disruptions when it comes to the Houthis in that. But it's something that markets are considering, and hence you have an additional premium being built into the price of oil as we speak, now that you have another party involved in what's going on in the Middle East, Yvonne.
Yeah, and the Houthi entry is sort of the next sort of thing to watch, right, as our BI analysts have talked about here, because it really kind of depends about where they're going to be targeting here in terms of attacks. There's no reports of, that Gate of Tears being attacked just of yet. But as you mentioned, that alternative route could be the next sort of thing to watch, right? So they're talking about this oil risk could expand beyond just the Strait of Hormuz to, of course, the Bab el-Mandeb Strait. And we're talking about 7 million barrels, as Dave mentioned, of Saudi exports through that Red Sea and that Yanbu port that could be at risk now. And does that mean, you got to reroute around Africa, the Cape of Good Hope. And so, maybe $15 to $20 is that added premium that you have to add to the oil price moving forward here. And speaking, just moments ago on board Air Force One, President Trump says Washington could soon strike a deal with Tehran to end this war. Take a listen.
Sir, could you foresee a deal in Iran this upcoming week?
I do see a deal in Iran, yeah.
Mr. President.
Could be soon.
They had offered that 15-point plan to Iran. Did they ever come back?
Yeah, they came back on the 15-point plan. They gave us most of the points.
Let's bring in our next guest. Juan Cole is a Middle East specialist and professor of history at the University of Michigan. Professor, good morning from the Asia Pacific. Thank you for joining us. I know it's getting quite late where you are. I don't know. Like, how big of a problem do you think is this? It's clearly a geopolitical issue. How big of an economic issue do you think this can be?
Well, economists suggest that for every $10 a barrel increase in the price of petroleum, you're shaving a tenth of a point off of world GDP. So we're already up $30 or $40 a barrel over the pre-war price. So that's 4/10 of a point. The United States was only going to grow 0.7% this year. So if it goes up more than this, you could well tip us over into a recession.
And it's different, right? I mean, it's different from what we hear from Liberation Day, where the president can just reverse a tariff rate. In terms of just reviving oil flows back in this market and ending this war seems to be a much more difficult task. With the Houthis now joining in on this conflict, Professor, I wonder, is this conflict now widening? What's at risk of that with the Houthis now joining in?
Well, the Houthis have a peace agreement with the United States, which they say that they're not at this moment prepared to violate. They did strike out at Israel, but they say they won't strike the Americans, and they haven't said that they would strike shipping in the Red Sea again, as they did during the Gaza war. So I think they're keeping their powder dry in case the United States does send land forces into Iran or attacks Iran's power plants, as President Trump threatened to do, then the Houthis might swing into action, which would be very bad for the world energy markets, because not only would some shipping of energy now have to go around Africa, but about 7 million barrels a day are being shipped out of the Suez Canal now, or from Yanbu. The Houthis can simply hit Yanbu. They could cut that off.
Professor, do we get to a point where, whether it's geopolitical capital or economic pain, where the White House is forced to back off? And the reason I frame it that way is you look across a lot of EM commentary across the world. The common complaint is, this is not our war, but we are paying for it. And I wonder whether that's alongside what some of the costs to actually mount this military offensive will force the White House to back down. And if it does, is it actually then only their choice, or does it need to get others involved? How deep in a hole are we, is my question.
We're in a very deep hole. I mean, the French are suggesting that as much as 30% of Gulf refinery capacity has been damaged. So you could stop the war tomorrow. You can't get that back suddenly. It's going to take months to repair it. The damage done to the Ras Laffan liquefied natural gas facility, yes, in Qatar. That could take 3 to 5 years to repair, and they knocked out 17% of the capacity. That gas would go to China, to East Asia. So there's a lot of damage to the economy already built in, even if you stop now. You go on another month like this, it's going to be the biggest energy shock the world has ever experienced.
Let's talk about the diplomacy. I mean, there's still some undergoing. I mean, Pakistan certainly seems to have led the fray here in terms of hosting these U.S.-Iran talks. What do we need to see for some sort of deal? I mean, it seems like both sides are quite in opposite ends of the spectrum here right now. What would a deal look like in your eyes?
There's no rapprochement. There's enormous distance between the two sides in how they envisage an end to this war. I think the Iranians have the ace in the hole here. They can sabotage energy exports out of the Persian Gulf through the Strait of Hormuz, and they can sabotage energy exports, which are 10 to 15% of the world total, through the Red Sea. So I think they get to decide when this ends. If they feel comfortable that the attacks are over, and they're saying they don't want another situation like last summer when there was a 12-day war, and then the Israelis and the Americans prepared for a further attack, and now they've launched it. They don't want to go through this again next year. So they want a situation in place where they're guaranteed against having their economy destroyed by Israel and the United States at will.
So how does this end?
I think the Israelis and the United States have to stop bombing Iran. And in the aftermath, it is very likely that Iran will have a toll system through the Persian Gulf, so that they're going to be making some extra money off of this for their reconstruction. I don't see a way in which the United States and Israel get out of that.
The strategic objective of political change is, doesn't necessarily follow, military bombardment. Military bombardment gets you a long way; it doesn't get you all the way. Is some level of boots on the ground, some version of that, likely to get that solution through, or is there another? In other words, should markets be prepared for that scenario?
It is very difficult to tell. You see some gray in my hair here. I lived through the Vietnam War, and I remember President Johnson gradually getting pulled into Vietnam and gradually not satisfied with bombing the North and putting ultimately 500,000 troops into the country, and they still couldn't win on the ground. Iran is enormous compared to Vietnam and has much more challenging and rugged geography. I personally don't see a way in which a land invasion of Iran by the United States doesn't end in complete disaster. And it would certainly put off any resolution of the war to where the energy crisis will accelerate.
Juan, we got to leave it there. Thank you so much. Juan Cole there, University of Michigan professor of history, joining us. And coming up, we're going to speak exclusively and talk a little bit more about earnings away from the geopolitics and speak to Chinese biotech company Hua Medicine about their product pipeline. Plus, we talk strategy with Citi from their macro conference in Hong Kong. Jim McCormick joins us in just a bit. This is Bloomberg. All right, we're talking about Hua Medicine now. Chinese biotech company has reported its full-year earnings results with revenue topping 490 million renminbi. That's up 93% from last year. Its main drug, dorzagliatin, is designed to help repair the body's glucose sensing function, which plays a key role in diabetes management.
Yeah, let's get more. And exclusively joining us is the company Hua Medicine Chief Strategy Officer from San Francisco today, George Lin. George, good morning from the Asia Pacific. Thank you so much for being patient. I know you've been waiting, but let's get straight to this. When do you plan to start marketing in Hong Kong? I believe you just got approval for that.
David, could you repeat that? It was coming in and out. Sorry about that.
Oh yeah, so I was about to say the drug you got approval for here in Hong Kong. When do you expect to start marketing and selling that?
It could be as early as the summer of this year. We're getting our distribution agreement in place. It's exactly the same drug as what is marketed in China, which has been approved since late 2022.
Can you tell us a bit more about this? Is the first year that you did sell dorzagliatin by yourselves instead of relying on a partner. And in effect, it seems like your revenue almost doubled compared to last year. Do you expect that same sort of growth for 2026?
We're expecting a pretty robust growth because we had to start our Salesforce team from one person as of January 1, 2025. We're now up to about 180 people, but there's still many provinces that we have not entered yet. On top of that, a lot of doctors and patients are, using the drug in different ways as, type 2 diabetics will, like combination. As you guys know very well, GLP-1 is very popular. And we recently reported through an independent investigator that did a study in China, the combination actually shows that the combination is superior to either drugs by itself. And so things like that will provide a very nice backwind for us to continue driving growth.
George, I'm wondering if you could provide the markets maybe some rough guidance, maybe some rough projections or specific numbers, if you have them, in terms of how much you plan of this specific drug you sell in China. And if you are able to market here in Hong Kong, how much have you penciled in as far as projections go?
Yeah, Hong Kong, I would say Hong Kong's still a little bit speculative. We're just trying to, get that distribution going. So I'll table that. But China is going to continue to be a huge market. As a publicly listed company, we don't give guidelines, but we've actually done something very interesting, which is taking a page off of Elon Musk, for example, for, in our incentive plan. our actual team has basically agreed with our board that if we hit 1.3 billion renminbi in sales for 2027, then our options will vest. If we don't hit that, then actually our options won't vest. So I think that's not necessarily a guideline that I'm giving you, but it's actually publicly announced. And that you can kind of get a sense of our confidence level of how much we're going to grow by 2027.
Yeah, and there's so much that's changing with these weight loss drugs, right? When we were just talking to a previous guest in the biotech sector about this patent for one of the ingredients that goes into Ozempic does expire in China, also in India, Canada as well. Analysts are all expecting that a lot of these generics are going to come into this market pretty soon. Does that change how you kind of look at this drug and how to commercialize your own sort of drugs here and the strategy moving forward?
Yeah, so that's a great question, and the answer is actually quite clinical. Is if you're obese and you're type 2 diabetic, you're probably not going to take our drug, right? Because there's GLP-1. Our drug actually does not induce weight loss, but there's about 580 million type 2 diabetics globally, 130 million in China. And a lot of the diabetics, especially in China, are not obese. So you wouldn't necessarily want those side effects or to lose any weight. And so those are the population that we're taking. Now, having said that, generic is going to increase accessibility and affordability in China and India. Semaglutide is the drug you're talking about, which is Novo's drug, GLP-1. That drug has gone generic in China and India as of this year. And as a result, that's going to drive prices down across all of that class, not just semaglutide, but actually any GLP-1, right? The National Reimbursement List Board will be able to have that leverage. That's going to increase accessibility and affordability. And the beauty of that for us is, like I mentioned earlier, an independent investigator actually conducted studies in China of the combination of our drug with semaglutide and showed an improvement from about 75% response rate monotherapy of semaglutide, GLP-1, to almost 100% with our drug. And increased weight loss and reduction of glucose level, and also a smaller waist circumference. So these are like, it almost super induces. Imagine a black coffee, and now you get like, a cafe latte by adding our drug. And the reduced price doesn't, at the end of the day, net, right, it doesn't really affect the patient, because most of these drugs are actually reimbursed when they're generic anyways, and then our drug is reimbursed, and so the reduced price and the combination ends up kind of being net the same as monotherapy before it went generic.
That's a good reminder to short the belt makers. So beyond Hong Kong, which I guess you're in the very early stages of planning as well, are you looking at other markets in the region for this drug, specifically Southeast Asia, South Asia? Take us through your expansion plans beyond just this year.
Yeah, our first generation drug, dorzagliatin, as I mentioned, received approval in Hong Kong, and so we're going to launch that this year. We've submitted our application to Macau, so waiting for that to be formally approved. And then we'll probably also increase in Southeast Asia with our dorzagliatin, which is administered twice a day orally. It's a chemical drug that we in-licensed from Roche. We do have a second generation drug where the patent goes out to the 2040s, and instead of twice a day, it's once a day. And we're actually doing clinical trials in the United States now, testing effectively for a maximum tolerated dose to increase the efficacy in glucose reduction, but also increase GLP-1 secretion in your body that's endogenous, as opposed to the exogenous GLP-1s that you see currently on the market that actually has a lot of associated side effects. So in the future, the international expansion to the Western world will be with the second generation. We're expecting that data to post probably in the middle of the year. And on the back of that data, we would go out and talk to international partners to embark on pretty large-scale global trials for that.
Yeah, I was going to ask you about this second-generation diabetes drug that you are currently testing, George, and also seeking for maybe some potential deal to develop it outside of China here right now. Any updates you can give us? Any sort of future collaborations?
Yvonne, I'm sorry. You're kind of breaking in and out. Could you just repeat that again?
Oh, yeah, I was going to talk about that second-generation diabetes drug that you are testing. I believe you're also looking for some potential deals to develop it outside of China. Can you give us any update on any future partnerships?
Well, it's taken us a while, actually, to do the phase one, and that's because we've been receiving a lot of very welcomed input from Global Pharmaceutical as to what the current phase one that we're running should look like and what kind of biomarkers they're looking for that. So as I mentioned, until we get those results, probably by the middle of 2026, there's really no progress that we can report right now. There's a lot of big pharmas that are looking at this specific drug because it is a global only in class. And that's very different from what you're seeing in the diabetes and obesity space.
George, thank you so much. Let's speak again soon. Let us know when you're here in town. George Lin there, Chief Strategy Officer at Huan Medicine. A quick glance at markets, and we'll talk more about the big stories coming up next. This is Bloomberg. Right, we're just approaching the lunch break over in Tokyo, and we're also just approaching the latter part. I mean, we're about to wrap up March, which has really been terrible, and really what an end to the month it's been. More on the markets coming up next, plus some intervention risk in Japan is propping up? Question mark.
Economists suggest that for every $10 a barrel increase in the price of petroleum, you're shaving a tenth of a point off of world GDP. So we're already up $30 or $40 a barrel over the pre-war price. So that's 0.4 of a point. The United States was only going to grow 0.7% this year. So if it goes up more than this, you could well tip us over into a recession.
I think what the Fed's dealing with right now is the triple whammy of deportations, tariffs, and now the war. And so that just adds to the uncertainty the economy was already facing. You know, it's amazing. The U.S. economy has been very resilient, but it's showing real signs of fragility right now, and so the Fed's very worried.
Some more insights from our guests there and the impact of this escalating war in Iran. As you see, right, $116 Brent this morning as we wake up on this Monday morning with, the conflict still in some ways widening with the Houthis' entry into the situation certainly does complicate things a bit. That's why you are seeing equities falling out of bed in Tokyo as we approach that lunch break now. We're down 4.5% for the Nikkei here and 159.84. So the yen is strengthening of late after we heard from officials with some verbal intervention, right? So bold action may be needed if this situation continues. You do see JGBs kind of following Treasury yields a bit lower here this morning as well, Dave.
It does seem that 160 handle was an itch that needed to be scratched somewhat, and that's not a normal move, right? 2,500 points to the downside on the Nikkei 225. That's really pulling down the benchmark. We're now down 12.5% on the Asian benchmark, specifically from the very top. Let's have a look at how we're doing across the region, across sectors, and the snapshot of these markets, including where you are on the U.S. dollar. And, we are moving into the time of the year when most in the world, it should be spring, it should be sun and rest and relaxation. The SNR has become stagflation and recession, really, to replace those two things. And will the PMIs this week that come out reflect this initial worry across these markets? First set of soft numbers are due out. This will reflect March, where we've been caught, of course, in the war for all of March so far. The estimates so far are holding up, and I wonder whether or not we will see these downgraded somewhat as we go into the thick of things. But yes, lots to consider on the macro front.
Yeah, it's not just the March-April data that's underway. It's also the earnings that we might be hearing, and what we're hearing from CEOs about what they're saying about the impact this Iran war might have, right? And it's perfect timing to really hold a conference. The Citi Hong Kong Macro Conference is underway with leading economists, policymakers, and strategists discussing global developments. Joining us now from the event is Jim McCormick, Citi's head of macro strategy. Jim, it's great to have you in town. Just tell us what it's like there at the conference. I'm sure Iran has dominated a lot of the discussions here. What are the panels? What are people talking about?
Yeah, I mean, it's early days in terms of the conference, but I mean, the first session, which I hosted, was all about Fed policy and how the Iran conflict impacts it. And I think the clear message here is it's going to be a very difficult time for central banks because we're talking about a genuine stagflationary event, which is going to be very likely to be much weaker growth, but also potentially much higher inflation.
And reaction function across central banks, is it, we're now about 4 weeks into this, 5 weeks now, if you consider Monday. Do we have a better sense of how they will likely react on the monetary policy front, Jim?
Yeah, I think last week was a pretty important one because if you look at the interest rate markets, the initial instinct was to think that this was going to be a significant new round of tightening, more outside the U.S. than inside the U.S. But last week, you did start to get a little bit of pushback. So ECB is telling you they have time to wait and see. Bank of England said the same thing. So we finally started to see a little bit of the pressure come off of the front end of rates curves. So central banks are telling you they just need to wait and see.
How do you see it in this part of the world? I mean, it seems like Asia is taking it the hardest in some way, given that, much of this region are energy importers. Do you think, can they afford to hike rates here to fight off inflation at a time when there is concerns of demand destruction?
Yeah, I mean, Asia, I certainly would not want to be a central banker. And I think what we're seeing so far is probably the right mix, which is you're not hearing especially hawkish talk from central banks. So Bank of Japan, who probably should have been hiking even before, doesn't seem to be in an urgent hurry to hike rates again. And what you're getting, I think, is more and more suggestion that the support is going to come from fiscal policy. So probably less tightening than the market expected early on, and a lot more support coming from fiscal policy, which to me means that we should have steeper curves globally, including in Asia.
And we've seen the opposite. We've seen yield curves flatten. I think we've gone from 140 basis points to about 100 on, I think, the 2s and 30s in the U.S. Is it time to be putting in those steepener trades at this point? And what do you think about current absolute levels in yields? Have they priced in, you think, what we know, or are they too low?
Yeah, so listen, I do think price action last week, alongside some of the central bank pushback on the amount of rate hikes that were priced, are telling you that this is a good moment to start thinking about steeper curves. As far as what's the right optimal level of yields, I've been making the case for a long time that we're not there. And if anything, this new inflation shock, alongside a new round of potentially significant fiscal spending, is likely to push long-end bond yields significantly higher from here in the coming months.
We know the dollar has become the one that has reigned supreme in all this volatility right now, Jim. Just wondering, is there more upside for the dollar here? It seems like when you take a look at how the euro, the renminbi has been sort of an anchor of stability in this part of the world as well. How much further dollar upside is there?
Yeah, I mean, listen, I think the FX markets have been the most interesting in this conflict in that they're caught in two minds. So I think the initial acute story here is that this is a major terms of trade shock, a terms of trade shock that's a big negative for Asia, a pretty big negative for Europe, and the dollar benefits because the U.S. is energy independent. Right now, it's probably one of the only energy exporters. So I think that we need to assume that the longer this conflict goes on, the more likely it is that the dollar could increase even further. But I also think that looking out into the medium to longer run, there may be an argument to go back and look at what the dollar was doing before this conflict, seeing people were starting to diversify out of the U.S. And I do expect that trend to resume. But right now, we need to focus on the terms of trade story. And that terms of trade story, I think, is a pretty big dollar positive.
Jim, speaking of looking at what was happening before the war started, which is almost a very challenging exercise, one thing that was noteworthy was we were having problems globally to bring inflation down, and then you have this. To your point, bond yields need to be much, much higher. Does the next 12 months does it seem like a good idea to take on more risk, given that backdrop?
No, listen, I was quite struck by, I don't want to call it complacency, but that is kind of what it was in terms of how the market was looking at inflation before the conflict. Because the truth is, if you look at core inflation across the G10, it had flatlined at 3% for the past couple of years. So we were making no further progress toward 2%. Before this conflict started, we already had some upside inflation risks from commodity prices. We had some upside inflation risks from tariffs. And now you overlay this, and suddenly we're looking at a world where core inflation in the G10 having flatlined at 3% could be significantly higher in the coming months. So I do think this is a mark the moment for what's been a 6 to 7 year change in inflation. This is another commodity price shock. And I think the risk to bond yields on the back of this are significantly higher.
China certainly has been interesting, given that we have seen deflation in this economy for many months now, Jim. I'm just wondering, there's this sort of narrative that's emerging that this whole reflation story can finally kick in China because of the spike in energy prices, because what we've seen with efforts to fight off involution. Do you finally see reflation coming back to China this year?
Well, I suppose it depends on how you define reflation, because reflation is oftentimes viewed as a positive because it's good growth and higher inflation. My worry is that the mix we're looking at, which seems quite obvious now, is more stagflation. So I don't know if I'd look at it as a positive, but I do think we're going to be looking at a world over the next 6 to 9 months where growth is going to be marked down as a result of this conflict. Inflation is going to be marked up. It's not great for bonds. It's not great for equities. It's a pretty bad mix for markets in general.
Jim, a pleasure to have you on the show. Jim McCormick, their head of macro strategy at Citi. Of course, you're having your macro conference here in Hong Kong. And of course, the backdrop there is also one that is, I guess, somewhat as depressing a note as Jim was noting there. Amber rainstorm warning, by the way, has been was hoisted over Hong Kong past tense. Right. Just ahead, Indian banks pushing back on this move coming from the central bank to protect the currency, warning of an unwinding of positions worth $30 billion. More in our scoop just ahead. Right, welcome back. Let's talk about this tussle in the currency market, specifically in India, where you have, of course, on one hand, you have authorities wanting to limit and address the weakness in the currency, and of course, the means to do that. In India's case, Bloomberg has learned that Indian lenders are urging the central bank to rethink some of these rules as it pertains to those FX transactions designed to shore up the value of the currency. And the rules were actually announced after the currency fell to a new low just going into the weekend.
Yeah, let's bring in Avril Hong. She's been joining us with more on this story. So first of all, tell us how significant this move by the RBI is.
Yeah, this is a significant shift. I think these are some of the most forceful measures we've seen from the RBI to try to shore up the currency that we've seen in more than a decade. And this is coming as the cost of defending the Indian rupee has risen. By some accounts, I think it's something like $30 billion in terms of the drawdown to the foreign exchange reserves that the RBI has been using in the first 3 weeks of March to defend the local currency. Now, these latest measures essentially basically mean that the lenders that act as authorized dealers will have to ensure that by the end of each trading day, their outstanding positions don't exceed more than $100 million. And why this is seen as a significant step is because, as we know, the RBI now typically uses the spot or forward market intervention to help prop up the rupee in times of distress. But we have been seeing this move, based on what some of these analysts have been highlighting, is that this is a move from direct market intervention to actually controlling, in a way, the market positioning. So you can see the sense of that shift and how significant this is, though they have also highlighted that at this point, maybe it could help to bring in some near-term stability. It does not help to change the longer-term fundamentals on the rupee, which, of course, as you highlighted earlier, Dave, has breached the 94 handle, and it's Asia's worst performing currency so far this year.
Yeah, how are the banks reacting to this? Has there been pushback? I imagine there has been. What's the pushback been?
Yeah, they haven't been reacting very well. Sources telling Bloomberg that in talks on Saturday, some of these lenders have been seeking to get the RBI to rethink these new rules, right? Because for them, they've already built up these positions. And I think the outstanding positions, according to sources, is also exceeding about $30 billion for these lenders. They've been trying to get the RBI to push back at least the date on which these changes will come into effect, which is April 10th, or to make sure that these new rules actually only apply to new bets. Now, for these lenders, you can imagine when trading begins, and we're already seeing some signs of it in early positioning, that they likely will have to sell these dollars in the local currency market that could push up the Indian rupee, and we are expecting to see those market moves when trading on the rupee begins in the next hour.
All right, April, thank you. Of course, we'll watch as Indian markets open up. Meanwhile, we're talking to the head of the South Korea's $1 trillion National Pension Service, saying that action may be needed to strengthen the won, which has tumbled against the dollar since the outbreak of the Iran war. Kim Song-ju told us exclusively about how the country's largest retirement fund is assessing the conflict's impact on returns.
Yes, looking just at January and February of this year, we were actually performing better than last year. However, it is true that we are currently facing significant challenges with our returns due to the recent conflict between the U.S. and Iran.
What kind of challenges are you facing, and has the Iran conflict led to any changes in your asset management approach?
Well, although Korea isn't a direct party to the war, it's becoming one of the most affected victims. The reason is that Korea relies heavily on Middle Eastern oil, and industries like petrochemicals account for a large portion of our economy. So it seems we're suffering the most damage from the U.S.-Iran conflict compared to other countries. In response to this crisis, we have been continuously operating our own crisis response teams. The Risk Management Committee, which I chair, is currently preparing and implementing various response plans based on different scenarios.
Does that mean changes in asset allocation or investment strategy?
We do not believe there is an imminent need to respond in that manner. I believe we need to make some minor adjustments and take certain measures to minimize the impact on each sector while maintaining our current basic allocation strategy and portfolio.
What kind of adjustments?
구체적으로 대응에 대해서 다 상세하게 말씀드리기는 조금 곤란하고요. It is a bit difficult for me to go into detailed specifics regarding the measures. However, we are scrutinizing the areas where we have higher exposure more closely. That said, NPS's current investment weighting in the Middle East is relatively low. While we are not incurring any direct losses, the reality is that the Korean economy, particularly the Korean stock market, is suffering severely from the fallout of this war, and NPS's returns are consequently being significantly impacted.
수익도 크게 영향을 받고 있는 그런 현실입니다.
그러게요. 국내 주식이 작년만 해도 되게
Right. Domestic equities performed strongly last year and seemed to lead returns, which led you to reduce overseas equities. So are you shifting in a different direction this year?
사실은 작년에 국내 증시가 다른 글로벌 증시에 비해서 굉장히 실적이 좋았습니다.
Actually, last year, the domestic stock market performed exceptionally well compared to other global markets. Just looking at the National Pension Service alone, our return on domestic stocks exceeded 80%. Yes, but since it was difficult to predict whether this trend would continue this year, we made a slight adjustment at the end of January to maintain that momentum. However, we are keeping the overall strategy intact. We plan to monitor the situation for a few more months and then decide at that time whether changes to our asset allocation and portfolio are truly necessary.
환율 안정성에 있어서는
Should MPS play a bigger role in stabilizing the currency?
예, 사실은 이제 국민연금의 환 대응 전략은 포트폴리오상의 변동성을 최대한
Yes, actually. The National Pension Service's foreign exchange strategy is to minimize portfolio volatility as much as possible and protect the fund from large-scale foreign exchange losses. Within that framework, the goal is to generate stable returns. As the won, which has been relatively stable, has recently shown relative weakness, the National Pension Service's concerns are deepening. However, given that Korea's economic fundamentals are strong and corporate earnings are high, it makes no sense at all for the won to be weakened so sharply. The National Pension Service has been responding to exchange rate fluctuations in accordance with its basic principles. Recently, due to the war, the won's weakness has persisted for quite some time, so there are internal discussions about the need for new policies at the National Pension Service level.
책이 필요하다고 하는 게 내부적으로 논의되고 있습니다.
환율 1,500원
Is 1,500 won per dollar the new normal?
그렇다고 보지 않습니다. 저희는 적정
I do not view it that way. We believe the appropriate exchange rate is in the low 1,400 won range.
지금 세계적으로 이슈가 되는 게 사모 대출 시장에 대한
Another global concern is the issue around the private credit market. What's the scale of MPS's investments there?
현재 NPS는 이와 관련된 투자 손실.
Fortunately, the NPS has not directly invested in any funds that have experienced investment losses or redemption suspensions related to this issue. So there is currently no risk of fund losses. However, since crises often start small and escalate, we are closely monitoring the structural vulnerabilities in the private credit market and responding accordingly.
대응하고 있다 말씀드립니다.
Yeah, the chairman and the CEO there of South Korea's National Pension Service, Kim Sung-ju, there with, of course, Sherry. Right, a reminder of our new online feature, the Bloomberg Video Hub. Subscribers can explore live streams. That specific interview, you can watch it back. Live news, interviews. Check it out, bloomberg.com/videos. Right, welcome back. Some AI chip or DeepSeek related names, we're focusing on that. Nothing consistent so far, but I guess the story is still worth paying attention to. And as far as the company, it's investigating this hours-long AI outage that's after some users, of course, had brought that to, I guess, the attention. But yes, nothing so far. And as far as the reaction is concerned, keep in mind, of course, broadly speaking, we are seeing a declines across most sectors today, except for, I think, palm oil stocks, I think, should be going the opposite way, if I'm getting that correctly. Let's have a look at that, please, if we can. There we go. Yes, and some of the names, of course, listed in Malaysia, specifically on the back of, I guess, the outlook there for the biofuel, and just staying on commodities, basically, too.
Yeah, so there could be the alternative, right? This higher demand for biofuel as crude climbs. And so aluminum is probably the next thing to watch here as well, given that some of these Middle East facilities were targeted and struck over the weekend here. You did see the LME contract spike here, and that's why you're seeing Asian aluminum shares are rising here this morning as well. That's it for us here in the China Show. See you later.